Good afternoon everyone, I am Rojan Aca-ac, and for today's video, I'll be discussing risk return and asset pricing models. For this discussion, let's start with risk and return. These two terms are very much related to one another. So risk is the variability of possible returns associated with a given investment. Risk, along with the return, is a major consideration in capital budgeting decisions. As we all know, in an investment, there will always be a risk. It is either you'll get the expected return or you will incur a loss. Or just like in any game, contest, or gamble, risk will always be present. It is either you win with a prize or return or you lose. And in relation to that, there is a term called risk-return trade-off. So what is risk-return trade-off? As stated in the presentation, it states that the potential return rises with an increase in risk. It means that when you are expecting a higher return on your investment, the risk that comes along with it is also greater or higher. Sounds familiar, right? And yes, it is what you are thinking. Low risk, low return, high risk, high return. It is this principle that when your investment is associated with higher level of risk or uncertainty, the potential returns you'll receive is greater as well. And when it is associated with low level of risk or uncertainty, the potential returns you will get is also low. By that, we can say or conclude that the relationship between risk and return is directly proportional. So the higher the risk, the higher the return, and vice versa. As for example, according to the risk-return trade-off, invested money can render higher profits only if you, as an investor, will accept a higher possibility of losses. So as much as you want to get a higher return, you must also be willing to accept the risks that comes along with it. Next is we have risk aversion. Risk aversion plays an important role in determining a firm's required return on investment. It is a concept based on the behavior of firms and investors while exposed to uncertainty to attempt to reduce that uncertainty. So it refers to a decision where you rather receive or choose an option that will guarantee you, even it means you'll receive low or less returns, instead of choosing the one with higher returns, but it is associated with greater risk, and that includes the chance of losing value. When you are a risk-averse kind of investor, you are avoiding uncertainties. It doesn't matter if you'll receive less as long as it is guaranteed that you will have something in return rather than nothing at all or losing everything. So sa Tagalog pa, doon ka sa sigurado. So in risk aversion, there can be three levels. So we have first is the risk averse or risk avoiding. It was defined earlier, so now let's have an example. A risk-averse investor might choose to put his or her money into a bank account with a low but guaranteed interest rate, rather than into a stock that may have high expected returns but also involves a chance of losing value. So ito yung klase ng mga investors na ayaw or natatakot sumugal. So second one is we have the risk neutral. It is a concept used in both game theory studies and in finance. It refers to a mindset where an individual is indifferent to risk when making an investment decision. It means that an investor is most likely will focus on potential gains when making investment decisions. So they may understand the risks involved, but they are not considering it for the moment. So let's have an example, but comparing it with risk averse. So the situation is that you will gain 5,000 pesos but with a risk of losing 100,000 pesos. And the other is there is a gain which of the same amount of 5,000 pesos but only risking 10,000 pesos. So, as a risk-averse investor, you would obviously choose the second one, which is to risk only 50,000 pesos with the same gain. But as for a risk-neutral investor, you would not mind the risk, so you'll choose the first one. So as a risk-neutral investor will again looks at the potential gains of each investment and ignores the potential downside risk of the investment. And third one is we have the risk-seeking or risk-loving. So this is the total opposite of risk-averse. Risk-seeking is one's acceptance of greater risk and uncertainty in investments or trading in exchange for the potential higher returns. So risk seekers are more interested in capital gains from speculative assets than capital preservation from lower risk assets. So risk-seeking kind of investors confers a high degree of risk tolerance or the amount of potential losses an investor is willing to accept. So ito yung mga klase ng mga investors na hindi natatakot sumugal. We have managing risk and return. So there are formulas, strategies, and algorithms abound that are dedicated to analyzing and attempting to quantify the relationship between risk and return. So for today's presentation, I will give two out of those. First is we have the Roy Safety First criterion. It is also known as the SF ratio. It is an approach to investment decisions that sets a minimum required return for a given level of risk. And another popular measure is the Sharpe ratio. Its calculation compares an asset's return to the performance of a risk-free investment. Most commonly is the 3-month US Treasury bill. Let's proceed with our next topic, which are the asset pricing models. First off, we have the present value model. So a present value model, an asset can be defined as a right on future cash flows. It is therefore straightforward to assume that the value of an asset depends on these cash flows. And as we concentrate our analysis on the cash flow of an investor, it consists of the dividends paid by the company, neglecting capital repayments and other infrequent forms of cash flows received by investors. So it is then assumed that dividends are paid at the beginning of a period while the asset can only be bought and sold at the end of a period. This assumption can be justified by recalling that a dividend is paid from the company's earnings in the previous period, in most cases a quarter or a year, and therefore should be assigned to the holder of the asset in this period. So the price of the asset changes more with a persistent movement in dividends or rates of a return than a temporary movement of the same amount. So correspondingly, an increase in dividends and a decrease in the rate of return increases the current prices. Next is we have here the Gordon growth model. So this model assumes that dividends grow at a constant rate in perpetuity and solves for the present value of the infinite series of future dividends. And because this model assumes a constant growth rate, it is generally only used for companies with stable growth rates in dividends per share. So this model also assumes that a company exists forever and there is a constant growth in dividends when solving a company's stock. So the Gordon growth model, or GGM, is ideal for companies with steady growth rates given its assumption of constant dividend growth. Next is we have portfolio selection theory. Most investors attach their wealth to stock exchange markets, and most prefer combinations of different stocks since single stocks carry inherent risks. Therefore, portfolio selection is an important topic of investigation. So generally, portfolio selection aims to achieve certain long-term targets by allocating wealth to a set of assets. So when considering to invest into asset markets, an investor has to make three decisions. First is the amount he wants to invest into the asset market. Second is to determine the assets he wants to invest in. And third is to determine the amount he wants to invest into each selected asset. We have capital asset pricing model. Capital asset pricing model is the most prominent model in asset pricing, and it describes the relationship between systematic risk and expected return for assets, particularly stocks. So its basis is the portfolio theory with a riskless asset and unlimited short sales. Or the capital asset pricing model is widely used throughout finance for pricing risky securities and generating expected returns for assets given the risk of those assets and cost of capital. Asset prices will no longer be exogenously given but be an equilibrium of the market. Unlike in the portfolio theory, we do not consider only the decision of a single investor, but aggregate them to determine a market equilibrium. And here are the following assumptions of the capital asset pricing model. First is we have the no transaction costs and taxes. Assets are indefinitely divisible. Each investor can invest into every asset without restrictions. Investors maximize expected utility by using the mean variance criterion. Prices are given and cannot be influenced by investors. And the model is static and limited short sales, homogeneity of beliefs, and all assets are marketable. Okay, so next we have the intertemporal capital asset pricing model. This model is a consumption-based capital asset pricing model that assumes investors hedge risky positions. So the Nobel laureate Robert Merton introduced the intertemporal capital asset pricing model in 1973 as an extension of the CAPM or the capital asset pricing model. So this is a more realistic setting. We assume a perfect market, and this is an extension of the CAPM. So it is assumed is a perfect market model because of these assumptions on the right side. These are the following assumptions. All assets have limited liability, no transaction costs and taxes, no dividends are infinitely divisible. All investors believe that their decision do not influence the market price. All trades take place in equilibrium and unrestricted borrowing and lending of all assets at the same conditions. There are special considerations in intertemporal capital asset pricing model. Yes, it does acknowledge the importance of risk factors in investing, but it does not fully define what those risk factors are and how they impact the calculation of asset price or the asset prices. The model says that these factors affect how much investors are willing to pay for assets, but does little to address all the risk factors involved or to quantify as to what extent they influence the prices. So those are some of the asset pricing models I could share and discuss to all of you, and I guess that's all for today. Thank you so much for reaching this far. Again, I am Rojan Aca-ac from Section HH. Bye!